competency is a relative concept. And what a lot of us need, including the one speaking, is what I needed to get ahead was to compete against idiots. And luckily, there's a large supply. And Warren, if people weren't so often wrong, we wouldn't be so rich.
Hey guys, welcome back. If you're new here, my name is Senan and welcome to the Investing IQ YouTube channel. In this video, I'm going to be sharing the knowledge and wisdom of the one and only Charlie Munger, the lesser known half of the greatest investing partnership ever and long-term partner of Warren Buffett. I'll be talking about Charlie's investing framework and ideology in detail. I'll be reacting to some of his best insights. And at the end of the video, we'll be taking a detailed look at his portfolios to see what he's holding going into the future. As always, if you enjoyed the video or learned something new, please consider hitting that like button and subscribing to the channel. So it's widely known that Charlie Munger is one of the greatest investors of all time. Everyone knows Charlie as the vice chairman of Berkshire Hathaway and long-term partner of Warren Buffett. But back in the day, Charlie actually used to manage his own fund back in the 1960s. Charlie's fund performed so well that it actually earned a place in Warren Buffett's famous essay, The Super Investors of Graham and Doddsville. At that point in time, Charlie and Warren were just good friends and they both managed their own funds. According to Buffett, he convinced Munger, who was a Harvard Law School graduate at the time, to move away from law and told him he could do a lot better as an investor. He says even back then, his portfolio was heavily concentrated in very few stocks, and he was willing to ignore big price fluctuations to get to his destination. If we look at his results below, from 1962 to 1975, Charlie compounded money at around 20% per annum, compared to around 5% for the Dow. What's really interesting to note is that in the last few years of his fund, he suffered 2 back-to-back annual losses of over 30%. But he didn't panic, and the following year his fund rebounded by over 70%. Just something to think about given the recent drop in stocks over the last few weeks. The greatest investors pay no mind to market crashes, except if they have excess capital to deploy, then they'll probably buy more. It takes enormous psychological strength to endure 2 straight years of 30% declines and not freak out and do something stupid. Like imagine having 10 straight years of amazing performance with no down years, only to see your results dissipate in front of your eyes. But like all great investors, he didn't react and he just waited patiently for the market to get out of its depressive state. After he recovered his losses and then some, both Charlie and Warren decided to return the money to shareholders and close their funds. The reason they closed their funds, I believe, is they were sick of answering to idiot clients who were constantly reacting to the latest stock market news. And they would actually pull their money out of the fund at the most opportune times to buy. This annoyed Warren and Charlie quite a lot, and by 1965 Warren would set up Berkshire Hathaway, with Charlie joining him at the helm as vice chairman in 1978. Since then they've formed the most formidable investing partnership the world has ever seen. Since 1965, Berkshire's overall return is 2.8 million%, compared to just 23,000% for the S&P 500. Just to put that in perspective, $50 invested in Berkshire in 1965 would be $1.4 million today, compared to just $11,000 for the S&P 500. Now, Warren's investing style and philosophy is well documented, with many books, speeches, and of course the famous shareholder letters. But where does Charlie fit into all this? There's a really good extract here from the book Poor Charlie's Almanac that hits the nail on the head perfectly. The author says, "Learning from Warren isn't hard. There are many books about him. He regularly gives speeches and makes public appearances, and he's published lengthy annual letters for decades. But Charlie is more private. For this reason, many people fail to recognize that Charlie is a genius in his own right, and he has had a profound impact on Warren's investment philosophy, which Warren freely acknowledges." So how did Charlie influence Warren's investing style? And what even is Charlie's style for buying stocks? Well, for starters, Charlie, like Warren, both see themselves as owners of the business and not traders of stock, which is probably the single most important concept in all of investing.
Well, that was the most useful idea that Ben Graham ever had. Have the mindset of somebody that was buying into a business planning to hold for the long pole, and use that mindset when thinking of stocks. And neither one of us have ever departed from that one.
The main difference between Munger's style and Buffett's old style is the amount of businesses that they own and the quality of the business. Before Warren was influenced by Charlie, he was a strict disciple of Ben Graham's margin of safety and cigar butt investing. For those who don't know, cigar butt investing is essentially where you buy really cheap businesses. It doesn't matter if they're good businesses or lousy businesses, as long as they're incredibly cheap. So Graham's style was, you buy a large amount of cigar butt businesses, bought with a big margin of safety. And even if some fail, which they will, because you bought them with a big margin of safety and you bought them so cheaply, you essentially don't lose money. Or at least that's the idea. Charlie saw some issues with this style, and he tried to convince Warren to only buy high quality businesses that can compound for years and years. In Poor Charlie's Almanac, he says if you buy something because it's undervalued, then you have to think about selling it when it approaches your calculation of intrinsic value. That's hard. But if you can buy a few great companies, then you can sit on your ass. That's a good thing. This is the line of thinking that Charlie passed on to Warren, and it led to the creation of the popular phrase by Charlie, it's better to buy a great business at a fair price than a fair business at a great price. Buffett himself says that Charlie shoved him in the direction of not just buying bargains, as Ben Graham taught him. This was the real impact Charlie had on me. It took a powerful force to move me on from Graham's limiting views. It was the power of Charlie's mind. He expanded my horizons. Charlie, being a modest man, is quick to shut down the praise. He says he doesn't like to believe he's been this great enlightener of Warren. He says it's true Warren had a touch of brain block working under Graham, but he conceded that Buffett is so smart he would have figured it out himself at some point. What a cool guy. I actually think I'm in love.
Looks like the bastard's in love.
It's true Buffett made a ton of money following Graham's teachings. But if you look at Berkshire's greatest investments, all of Berkshire's best returns have come from buying wonderful businesses at fair prices. Businesses such as Geico, Coca-Cola, See's Candy, and Apple. These great businesses have been compounding machines for the last few decades, without all the hassle of having to flip cigar butt businesses. Overall, Charlie's investing philosophy is pretty simple.
We have to deal in things that we're capable of understanding. And then, once we're over that filter, we have to have a business with some intrinsic characteristics that give it a durable competitive advantage. And then, of course, we would vastly prefer a management in place with a lot of integrity and talent. And finally, no matter how wonderful it is, it's not worth an infinite price. So we have to have a price that makes sense and gives a margin of safety considering the natural vicissitudes of life.
So he only buys high quality businesses that he's capable of understanding. A quality business meaning it has intrinsic characteristics that give it a long-term competitive advantage, and a top-notch management team that operate with integrity and talent. And finally, no matter how great it is, it's not worth an infinite price. So you want to pay a price that makes sense and gives a margin of safety. Now, when he says margin of safety, he doesn't just mean buying at a big discount to intrinsic value, which is what a lot of people think margin of safety is. That would kind of contradict the saying it's better to buy a wonderful business at a fair price. Margin of safety is a very broad concept that you can use in many ways. One of the ways to incorporate margin of safety, which is the Phil Town way, is to take your calculation of intrinsic value and just cut it in half to get your buy price. So essentially you're buying a business for 50 cents on the dollar. But that's only one way of looking at it. Warren and especially Charlie think about margin of safety in a different way.
How do you judge the right margin of safety to use when investing in various common stocks?
We favor the businesses where we really think we know the answer. And therefore, if a business gets to the point where we think the industry in which it operates, the competitive position, or anything is so chancy that we can't really come up with a figure, we don't really try to compensate for that sort of thing by having some extra large margin of safety. We really try to go on to something that we understand better. So if we buy something like See's Candy as a business or Coca-Cola as a stock, we don't think we need a huge margin of safety because we don't think we're going to be wrong about our assumptions in any material way. What we really want to do is buy a business that's a great business, which means a business is going to earn a high return on capital employed for a very long period of time and where we think the management will treat us right. And we don't have to mark those down a lot when we find those factors. We'd love to find them when they're selling at 40 cents on the dollar, but we will buy those at much closer to a dollar on the dollar. If we find something where the competitive aspects are, it's just the nature of the business that you really can't see out 5 or 10 or 20 years, because that's what investing is seeing out. You don't get paid for what's already happened. You only get paid for what's going to happen in the future. The past is only useful to you in the extent to which it gives you insights into the future. And sometimes the past doesn't give you any insights into the future. And in other cases, like the stable business that you postulated, it probably does give you a pretty good guideline as to what's going to happen in the future. And you don't need a huge margin of safety. You should have something that you always should feel you're getting a little more than what it's worth. And there are times when we've been able to buy wonderful businesses at a quarter of what they're worth. But we haven't seen those times. Well, we saw it in Korea here recently, but you don't see those sort of things very often. And does that mean you should sit around and hope they come back for 10 or 15, wait 10 or 15 years? That's not the way we do it. If we can buy good businesses at a reasonable valuation, we're going to keep doing it. Charlie?
Yeah, that margin of safety concept boils down to getting more value than you're paying. And that value can exist in a lot of different forms. If you're paid 4 to 1 on something that's an even money proposition, why, that's a value proposition too. It's high school algebra, and people who don't know how to use high school algebra should take up some other activity.
If you've watched some of my previous videos, you'd know when I do a discounted cash flow for a business, the discount rate I use is 10%. Now, to a lot of investors, 10% is actually really high. Most institutional investors use a much lower discount rate of around 6 to 8%, but I use 10% as a way to incorporate margin of safety into my own calculations. And there's many other ways to go about it, as Munger says. Now, to quickly state the obvious, it's obviously preferable to buy a wonderful business for a wonderfully cheap price, but that doesn't happen very often. Like Buffett said before, obviously it's preferable to buy a wonderful high quality business for 40 cents on the dollar. But they're quite happy to pay fair value for a great business, rather than sit there for years or even decades waiting for the price to drop to 50 cents on the dollar. If it's a really wonderful business, it may never happen. People get too caught up in valuation, but it's the quality of the business that matters most. Munger likes to say you don't shop for parachutes based on the cheapest bid, and it should be the same with businesses. A really wonderful business will compound its capital at high rates of return, and then reinvest those profits back into the business to create enormous amounts of shareholder value over time. And the stock may never trade for 50% of its intrinsic value, but may still go on to be 10 baggers or even 50 baggers. I wonder how many people turn their noses up at wonderful long-term compounders like Amazon, Apple, Nvidia and Facebook, based purely on valuation bias. Nick Sleep calls it being penny wise and pound foolish, and Charlie Munger agrees. The last thing that separates Charlie from the rest of the investing community is the topic of how many stocks you should own. And this is a topic that divides a lot of people. Diversification is a word that's thrown around all the time in the investing world, but it's something that Warren and Charlie are dead against.
And some of these people write articles in the newspaper and other places, and they say, well, the whole secret of investment is diversification. That's the mantra. They've got it exactly back-assward. The whole secret of investment is to find places where it's safe and wise to non-diversify. It's just that simple. Diversification is for the know-nothing investor. It's not for the professional. So the whole idea of diversification, when you're looking for excellence, is totally ridiculous. It doesn't work. It gives you an impossible task. What fun is it to do an impossible task over and over again? I find it agony.
For the people picking their own stocks, owning 20 or 30 stocks can actually be detrimental to your performance. Trying to find 30 high quality businesses at reasonable prices is not easy. And buying more businesses just for the sake of diversification is ridiculous according to Charlie. He says he doesn't believe that widespread diversification yields good results. And almost all good investments involve relatively low diversification. This concentrated style of investing is known as focused investing, and it's how I personally invest as well. Charlie says the idea is that it's hard to find good investments, so only concentrate on a few. It's a really simple set of principles that most people just ignore. Most of the time, you'll never see more than 5 stocks in Charlie's portfolios. Which brings us to the last segment today, which is what companies does Charlie Munger currently own in his portfolios? As well as being vice chairman of Berkshire Hathaway, Charlie also manages a fund for the Daily Journal Corporation, which is a newspaper in California that also has around $250 million in a stock portfolio, where Charlie is the chief stock picker. A lot of people consider this to be Charlie's portfolio and Berkshire to be Warren's portfolio, but I'm sure Charlie can be credited with some of Berkshire's greatest investments, such as Coca-Cola and See's Candy. So let's take a look at the Daily Journal Corporation's portfolio and see what's inside. So for all intents and purposes, Charlie only owns 3 stocks: Bank of America, Wells Fargo, and Alibaba. Alibaba is a really interesting one, and it's currently in my portfolio as well, but it's interesting to see Munger own this type of business. A massive e-commerce based business with many arms, including a budding cloud business. Charlie being really good friends with Li Lu means he must have some insights there that most of us probably can't see. The top 2 holdings of his portfolio being banks make sense because of the huge sum of money invested. The dividends alone each year from these 2 banks would be a considerable amount. If I had a couple of $100 million, I'd probably buy some bank stocks as well, purely for the dividend income. It's also worth noting that Munger personally owns over $2 billion in Berkshire Hathaway stock. So that's by far his number 1 holding. It just doesn't show up here because it's not under the Daily Journal Corporation. I'm pretty sure Charlie still has another personal portfolio. He spends a great deal of time in interviews and annual meetings saying that he personally owns 3 stocks that he considers to be his 3 favourite businesses. First is obviously Berkshire Hathaway. Second is Costco, which is Charlie's favourite business. And the third is a fund of Chinese stocks ran by Li Lu. Li Lu being Charlie's good friend and also one of the greatest investors alive. Charlie having some of his personal portfolio with Li Lu shows the immense trust and admiration he must have for him. And I don't blame him. Honestly, I could sit here and talk about Charlie Munger for hours, but I know watching videos longer than 15 minutes can get a bit tedious, so I'll leave it at that for today. But don't worry, this won't be the last Charlie Munger video I'll make, and I'll be covering all of the investors mentioned in my poll at some stage. Shout out to the one person who voted for Nick Sleep. I was so happy to see someone voted for him, as he's definitely not talked about enough for how great he is. If you've enjoyed the video so far and you want to support the channel, I'd really appreciate it if you hit that like button. And if you want to join our little community or see more videos like this one, hit that subscribe button. Very soon I'll be setting up a Discord server where we can all hang, talk about investing and share ideas. So if you're interested, keep an eye out for that. And if you're still bored, I'll put another video up in the corner that I think you'll like. If you've watched the video all the way to the end, thank you so much and I really appreciate you watching. As always, if you have any questions about anything I said, please don't hesitate to let me know in the comments below. I reply to every single question and I try to reply as best I can. If you want to learn how I invest using the Buffett-Munger framework, or if you want to just download and use my intrinsic value spreadsheets, then check out my free course on the channel. I go into every aspect of value investing in detail. And as always, this video is not financial advice. Please always do your own research before making any investment decisions. That's it for this video. Thank you so much for watching and I'll see you guys in the next one.